I think the TCS numbers are coming through as we speak. So Rima is ready with us with the first cut. The first numbers are only trickling in right now. Rima, over to you.
Thanks so much for that. So TCS has reported a margin beat. That's the key highlight. The company's reported EBIT margins of 25.7%, ahead of street expectations of about 24.4%. Margins have expanded by 140 basis points quarter on quarter, and this follows 110 basis points margin expansion that the company had in the prior quarter. So two back-to-back quarters where the company is delivering on a strong operational performance. If you remember, the narrative about 18 months back was that of margin compression on account of supply-side headwinds. Attrition was skyrocketing. The companies were doling out bonuses, doing everything that they can to retain employees. And there was a lot of money being spent on backfilling the attrition. And that had crunched margin. But now, going by the performance in the last 2 quarters, it appears that those supply-side headwinds, which were hurting margins about 12 to 18 months back, is now easing. So this quarter, the company's reported a margin beat. 25.7% is what the company has reported in terms of margins, a 140 basis points expansion on a quarter-on-quarter basis, and even on a year-on-year basis, the company has delivered margins of 25.7%, which compares with 24.5%. So that's the key highlight. Now, when you look at the bottom line, the company has delivered an adjusted profit of 12,016 crore. The reason we're looking at an adjusted profit is because there was this long-drawn epic case, which finally got settled in the quarter gone by, and the company had said that they have to make a provision. To settle that case, they are making a provision of $125 million, which would hurt their bottom line. So the company has taken on that legal expense, and that's hurting their bottom line by 958 crore. So the reported profit number will appear to be much lower, and that's on account of an expected legal provision, a legal expense that the company has taken on account of an epic case. So therefore, most of the consensus all the consensus expectations were taken X of that. So we were looking at an adjusted number, and the adjusted profit number has come in higher than street expectations. The reported number will be lower quarter on quarter because of a large 958 crore impact that the company has due to that epic case, but that was known and already guided by the street. The street expectations were on an adjusted basis. So given the margin beat, the company has reported the company has reported a margin beat, and given that, there is a beat on the profitability. Another important factor is the TCV. The TCV for the company has come in at $8.1 billion. Fairly healthy. You would say it's lower on a quarter-on-quarter basis because in the prior quarter, the TCV standds for total contract wins. That is an indication of the new deal wins, new and old in the case of TCS. TCS reports deal wins as new and old. Infy reports only the new deal wins, and that also large, above $50 million. So they're not a like-to-like comparison. But for TCS, the company has reported 8.1 of deal wins in Q3. It's lower than what they had in the prior quarter, which was 11.2. But typically, December is a seasonally weak quarter, even for deal wins. So 8.1 would compare with, it's largely in line with what the company has been talking about. So wouldn't be too much of a, disappointment. Just talking about the statement that's come out from K. Krithivasan, CEO and MD, our strong performance in a seasonally weak quarter buffeted by macroeconomic headwinds demonstrate the strength of our business model with a well-diversified portfolio, customer-centric strategy. We're seeing strong deal momentum across markets, resulting in a solid order book, providing visibility into our long-term growth. We are seeing tremendous interest in generative AI, and we're leading innovation and exploratory efforts for our customers in this area. So the two key takeaways. One, Gen AI continues to be the hot topic of discussion, though the statement reads as exploratory efforts. So as of now, it's not that it's a material contributor to the company's financials. And secondly, is a reaffirmation that the deal momentum continues to remain strong, the order book is solid, and they have visibility into the long-term growth, not committing on the near term. Attrition on expected lines has come down to 13.3%, which compares with the 14.9% that they had. And if you remember, in the peak of the supply side, constraints, attrition for the company was in excess of 20%. So these are, the basic numbers. What I'm still awaiting is actually the dollar revenue number. Okay, dollar revenue number is still, missing right now. So that's the key number that we're still waiting. Let me go across to Sandeep Agrawal, who's now with us. He's from Sovilo. Sandeep, your first read on TCS's numbers. What are the hits? What are the misses?
So yeah, hi, good evening, and thanks for having me on the show. So, there are multiple hits, I would say. First of all, while we don't have yet the dollar numbers, but if you convert the rupee numbers which they have reported, it seems that there is a 0.5% beat on the revenue growth numbers as well versus estimate. So I think that revenue growth should be around 1.2% kind of number based on the back calculation which we can do. Obviously, it cannot be 100% correct correction, but seems to be, quarter-on-quarter growth should be in dollar terms 0.6, 0.7%, and in constant currency should be 1.1 or 1.2%. As far as margins is concerned, if you recall, Rima, we have been saying that attrition fall is a very, very big mover of the margins, and that is what is reflecting in the numbers. And in my view, further uptick in margins by at least 200 to 250 basis points in next 2-3 quarters is very much possible, with attrition coming to 13, and I think it will come down to 11 in next couple of quarters. So if attrition comes to 11, 12, which is their generally traditional attrition numbers, then your margin should also go to 26.5%, 27%. So that is another thing. And thirdly, as you rightly mentioned, that TCV is not at all something to complain about. It is decent TCV. And Epic case is known thing, so I think a provision regarding that should not be a shocker at all. So I would say all in all a decent set of numbers, and obviously decent whatever commentary I have heard on your show only, it seems that it is a quite confident commentary.
Okay, just one error. The margin improvement is there is a margin improvement, but not to the extent. So margins have come in at 25%, an expansion of about 70-75 basis on a quarter-on-quarter basis. So margin expansion trend is very much there. Margins have expanded, but the correct margins are EBIT margins of 25%. The company has also said that their constant currency revenue growth is at 1.7% on a quarter-on-quarter basis. One reason why the street was talking about how this the weak macro is hurting the growth rate. Look at the way the growth rates for the company have come down. I'm looking at the constant currency numbers. Okay, in Q2 of FY23, the company was clocking in a revenue growth of 15.4% year-on-year. It came down to 13.5%. They ended FY23 with a revenue growth of 10.7%, still in double digits. But now come to FY24, at the peak of the recession worries and the slowdown concerns. Q1 FY24 constant currency year-on-year revenue growth slowed down to 7%. Further came down to 2.8% in Q2, and now it's down to 1.7%. The expectation is that given the strong deal wins over the last few quarters, the company, this will all ramp up in maybe Q4 and mostly in FY25, which will help the company's growth rates rebound, the execution of these deals. Among the major markets, the company has said UK has done well. They have been guiding for UK doing well. North America is under pressure. So North America has seen a decline of 3%. They have been cautious about North America, and this time too, North America is weaker in trade. Sandeep, the company last time, if you remember, upped the order win guidance. So earlier they used to talk about an order win in a range of $7 to $9 billion. Last quarter they said that we can step it up, maybe $9 to $10 billion will be the quarterly run rate. Now this quarter it's come at $8.1 billion. Would you just attribute it to seasonality? Is there anything to read over here?
No, absolutely. This is seasonality because when the company talked about moving up the numbers, they talked about in a medium to long term. So I don't think it was immediate. And obviously this quarter, Rima, as you know, always seasonally weak. So expecting too much from this quarter will be a little far stretched. So I think, overall, all the numbers are looking decent. And particularly EBIT margin is very big positive surprise in my view versus estimate. Even at 25%, there is a surprise. And remember that attrition has now started coming off, so the benefits will flow in next 2-3 quarters in a big way.
Milind Lakkad, who is the Chief HR Officer, says the vibrancy and energy levels of our offices are increasing even more as employees are back to office. We expect to be back to normal operating mode by the end of the current fiscal year. So no more work from home. Employees are back and they expect a normal operating mode by the current end of this fiscal year. Attrition is trending down 13.3% and is now within their range, the comfort range. So attrition now is back to what TCS's long-term comfortable attrition rate is. They're committed to hiring from campuses and growing their talent organically. Just trying to, calculate what the headcount number has been this time, because the declining headcount addition by companies was also a bit of a worry for many of the people. So just, going to try and get some more numbers in terms of the headcount number. But, what can we expect based on this order win in terms of an FY25 growth rate? 4.7% is the dollar revenue growth for the first 9 months of the year, with EBIT margins of 24.1%. That's the 9-month performance. What can they end FY24 with, Sandeep, and what are the consensus expectations for FY25?
So, FY24, I think we will end up around 5% in terms of overall revenue growth. And I think EBIT margin will further improve in the fourth quarter because all the costs are now behind. So I think, 24.5 or 24.6 is something which the full year number should look like. And next year is the one where, first half you will be big beneficiary of all the deal wins which has happened. So I think, next year is a year where everyone is expecting around 8 to 10% kind of growth in revenue terms, constant currency, and decent margin than this year, around 40 to 80 basis point higher than what we end for the full year in 24, because, the attrition numbers will not be as high as we have seen in first half of this year. So that benefit will come in next year. So I think, 25.5% kind of margins and 8 to 10% kind of revenue growth is where everyone is looking at.
Okay, we're awaiting. We've got the Infosys numbers too. The company has reported a dollar revenue decline of 1.2% on a quarter-on-quarter basis. This is what the street was anticipating. Our poll threw the decline to be a little more severe at minus 1.8%. The company's top line has come down by 1.2%. EBIT margins have come in at 20.5%, largely in line with the CNBC TV18 poll of 20.4%. On expected lines, the company has lowered their FY24 revenue guidance. The earlier guidance was 1 to 2.5%. The new guidance stands at 1.5 to 2%. So they've tightened it. They have upped the lower end of the guidance and brought down the upper end of the guidance. I repeat, the earlier guidance was 1 to 2.5%. The new guidance is 1.5 to 2%. So they basically tightened it, narrowed the guidance range. The earlier guidance range allowed for that flexibility of 150 basis points. Now they're quite certain growth will be within 1.5 to 2%. So that's the new guidance. And the company has also maintained its margin guidance. That comes in line with the street expectations. The constant currency revenue growth for the company has declined. It's declined by 1% on a sequential basis. This is actually slightly better than what the CNBC TV18 poll had thrown up and what consensus expectations were. So the read from Infi is that the numbers are not as bad as feared. It's still a muted showing with a revenue decline on a quarter-on-quarter basis, margins coming down because of wage hikes, but not as bad as what the street was fearing. The company's total contract value, again, the deal wins, and in the case of Infosys, they only announced the fresh deal wins and the large deal wins. This time it's come in at $3.2 billion, which compares with $7.7 billion. The deal win announcement per se from the companies this time has been fairly muted. We haven't heard of large deal wins which dominated the narrative about 6 months ago. And plus, as I said, this is a seasonally weak quarter. Deal wins for Infosys at $3.2 billion versus $7.7 billion lower on a sequential basis. But that prior $7.7 billion for Infosys was also a record of sort. Lots of numbers trickling in. So let me just quickly, summarize the numbers for you. TCS has had a good showing. The company's, I think, constant currency revenue growth on a quarter-on-quarter basis is roughly about 1% on a sequential basis. Street was expecting flat numbers, so it's a good performance on the top line. Margins have expanded by 70 basis points to 25% versus 24.3%. In the case of Infosys, it's a muted showing, but not as bad as the worst fears on the street. Revenues have come down by, I think, 1.2% in dollar terms. Margins have come down by, 70 basis points on account of wage hikes. But again, it's, not it's not a very bad showing. And the company, on expected lines, has tightened its FY24 revenue guidance. The margin guidance remains intact. Sandeep is still with us. Sandeep, you want to come in and comment on Infosys numbers and what we've seen?
So, again, Rima, similar like TCS, I would say these numbers are slightly better than estimate on both revenue and margin front. Margin, everyone was around 20.3. They have come at 20.5. So that is slightly better. And also on revenue front, as you rightly mentioned, the decline was expected to be a little sharper at 1.4, 1.5% in constant currency. It is lower than that. So, and obviously, guidance has to be recalibrated because there is only a residual Q4. So I think that these numbers should also, you can say that they are either in line or slightly better than expectation. And TCS is also, again, slightly better than expectation. So I would say both the numbers are better than expectation. And the next year is what people will look at. And I think commentary when the earnings call happens and the press conference happens will be more important. Because that will give some highlight on how they are seeing the client budgets to be.
So Sandeep, the TCS management is fairly reserved about giving, very clear, indications of whether a macro recovery is underway and we are going to see a pickup. So tell us, when we quiz the management and there is a press conference, I'm here at the TCS TCS house right now. Tell me, what should be the top 3 things that you would like to hear from the TCS management? Something that they can answer.
No, so we definitely want to know, which markets they are seeing pressure and which markets they are seeing stability. Because see, if US market is the only one where they are seeing pressure, then I think it is a good news in the sense that, that pressure is now receding very clearly. We are seeing that in all the tech companies in the US also, the pressures are receding. So if that is the concern, then I would say it is more of a current concern. Outlook should be better. If there are new markets where they are seeing some kind of pressure or uncertainty, then that is something which needs to be built in. But the key markets is US, and if in US also they say that they are seeing lesser worries than earlier or some kind of positive statement, then it is a very big relief in my view. Second thing, on how they are building up their new capabilities on the Gen AI, how many people have been trained, that will be very important to know, to make a note, because basically when all these technologies stabilize and go for large scale transition deal, then obviously you need to come back to the larger vendors who can provide you with support at a large scale. So that is something which is very important. And thirdly, I would say that how the management is seeing the people retention, because while attrition for the whole industry is coming down, which is a good news, and at the lower level there are more people, so it can be averaging the attrition lower. But is there anything which they are seeing at the top level and middle level, and if it is so, then how they are managing? So see, this is a people's business, so people we need to know a little more about the people and the technology and obviously the markets, and this 3 sums up all the requirements what you need to know for taking a call for a longer term.
Okay, and how do you suspect the stocks, both Infi and TCS, will react?
See, I think, these numbers don't warrant any negative reaction on the stocks.
Okay. But the stocks have already had a pretty good run in the last 2 months. So are they pricing in this kind of a performance? Because it's not that it's, the numbers are suggesting that the recovery is actually underway today. They're just not a very poor set of numbers in that sense. They're not bad. They're good numbers, stable numbers from TCS, not bad from Infosys. So is there anything in these numbers to cause an upgrade and cause a stock rally?
No, there is nothing in the number to cause an upgrade. But Rima, markets are always very smart and ahead of time. So if you recall last year in Jan, when attrition numbers started going up, then all the managements were very bullish because demand was very good. but margin was collapsing because of high attrition. So stocks were sold off much before, actual pain came. And similarly, now I think last 3-4 months since August, everyone is buying. So I think, there is a lot more things to be positive about rather than negative. So markets will, I think, cheer with this number, and they will keep the good investors and long-term investor will start accumulating or continue to accumulate. So I don't think that, the short rally which we have seen in last few months is enough. I think there are more steam left in the large names at least.
Okay, Sandeep is bullish over the longer term. There is enough in the numbers to keep the faith in the IT stocks over the long term. Sandeep, thank you very much for joining in with your insights on, on both Infi and TCS. Prakash Diwan is also joining in. Prakash, let's address the two numbers one by one. First, your top three takeaways from TCS.
No, so honestly, the way the market was anticipating going into these results, there was not much of a build-up of expectations which are very high. So on all counts, if you ask me, at least on the TCS side, most of the things seem to be very much within the expectation band. There's nothing which is any way surprising, good or bad. So I know it sounds very indifferent of sorts, but that's the way these numbers, that's the way I read these numbers.
Okay, and what about Infosys?
So Infosys, there are a couple of interesting things, especially related to headcount and all, which in my view is something which probably starts telling you that things could change. We also saw that that interim increment that they had announced some time back, I think about a month back, that was the first indication that they're probably anticipating some sort of a build-up in order values, new contracts, or the execution could kind of ramp up. So that I think is again an endorsement or a validation of that view, which is something which probably seems more positive. So the market would probably like that and start believing that things could improve for Infi from here on.
Okay, actually, TCS's numbers, now when you look at it, are not bad at all. It's a revenue growth of 1%. Now, December, for most companies was expected to be a flat or a negative growth kind of a quarter. For TCS, the CNBC TV18 poll was for a flat constant currency growth. In comparison, TCS has delivered a growth 1% QOQ, and plus there is that margin expansion which the street was not anticipating. One of the key reasons for this beat appears to be the ramp up of the BSNL deal. BSNL deal was won last quarter. It was a large $1 billion deal, and the company in the commentary had spoken about execution, the deal ramping up in a near term, in 12 to 18 months. So if you look at the geography-wise performance, India appears to have done very well with about a near 25% growth on a quarter-on-quarter basis. Plus, the supply side situation, continues to, improve, with the attrition also lower by 160 basis points on a quarter-on-quarter basis and nearly 800 basis points on a quarter-on-quarter basis. The headcount for the company, though, continues to moderate. Even last quarter, we had a headcount decline. We had it in the previous quarter, and this time too, I think nearly 5,000, there's been a decline of more than about 5,000. About Infosys, just a quick word, it's a muted showing, but not as bad as the worst estimate on the street. -1% constant currency revenue growth. Margins have come down to 20.5%, and the guidance band has been tightened. 1 to 2.5% is 1.5 to 2%, and revenue margin guidance has been maintained at 20 to 22%. Prakash, we always ask you this, between Infi and TCS, which one? Based on these numbers.
That's always a challenge. But on the basis of these numbers, I would still go with Infosys. Not for any other reason, but it seems to be slightly ahead of the curve in terms of the change in trend. If there is an improvement come Jan, Feb, March, you'll see a lot of new contracts being awarded. And if that happens, the 1.2% down revenue for Infosys is far lesser than what we were kind of building up, right? And I think from a 6-month to 12-month perspective, Infosys could probably be slightly ahead of TCS in terms of moving through, and it's not performed. Last 12 months, it's always lagged by almost like 12% or 11% as compared to TCS for various reasons. So I think the catch up is more due on Infosys basis these numbers, which are much better, as I said, than most expectations, which are slightly pessimistic.
You know, Infosys is also said to have a higher proportion of discretionary projects in their portfolio, which are generally the discretionary kind of work that they do. So when the macro recovers, Infosys, according to analysts, could enjoy that extra bump up. It got hit harder compared to peers like TCS on the way down when discretionary projects were being cancelled or put on hold, budgets were being tightened, and the reverse will happen. When the tap opens for discretionary spending, according to analysts, Infosys could be better placed because in its portfolio, it has a higher dependence on these short cycle discretionary kind of projects. So that's one of the views on the street. We are awaiting, Prakash, the Infosys management. On the HR side, what's been playing out? Now, I'm not sure how much the management will comment on it, but is it a big worry from an investor point of view, this entire senior management attrition, or do you think that bench strength is deep, the leadership is broadly stable, and therefore it should not be a concern? It's more of a noise.
No, so theoretically, it should not be a concern, given all the other parameters around their bench strength and the kind of percentage of what attrition you've seen on this particular segment. But it's always a challenge in terms of how this cascades into something which is more of a deep-seated trend, which can be damaging. So what the street doesn't like is uncertainty, and if this continues to be something which the management has no control on or no visibility about, then it becomes an issue. So I think if it is calibrated and they've managed to mitigate it with some plans in terms of internal shuffles and resetting some of the responsibility metrics, then I think it should still be okay. So we'll have to wait for that and how articulate they are on this part.
Okay, thank you very much for that. Just trying to see if we get some more numbers. Yes, the TCS dollar revenue growth has come in at 1% growth at 7,281. That's the TCS dollar revenue growth, 7,281, a growth of 1%. The street was anticipating a bit of a flattish performance. Also, one more, correction. The profit figure, the adjusted profit figure for TCS is not 12,000 as we've been highlighting. It's, it's 11,735. So that's the adjusted profit figure we need to work with for TCS. But that doesn't take away from the fact that it's a good showing from TCS and Infosys too, not as bad as what the street was fearing. So are IT companies now back on that recovery path? We'll know. The the Infosys management will be joining in for their press conference very soon. So we'll get into a quick break. We'll come back with the Infosys management. Stay tuned.